Hey there, Dave Keller here with Market Misbehavior. I'm often asked about interest rates, especially when we've had this situation over the last 6 months or so, 12 months, where interest rates rose significantly. Coming from long-term lows, they increase and increase. 10-year yields went up to 1.6%, 1.7%. I had a lot of questions about what a rising rate environment means for equities because we've been in a lowering rate environment, a falling rate environment for so long. Now all of a sudden you see a bit of the opposite. You see rates actually coming down. You see the yield curve flattening. But if you ask me how does the yield curve or how do interest rates impact stocks, my short answer is it's complicated, right? There are a lot of moving parts in there, and you're looking at one sort of set of circumstances. However, by looking at charts of bond prices, bond yields, interest rates, of course, the shape of the yield curve, and then certain stocks and sectors, you can start to understand the relationship and understand what rising or falling rates, what a steepening or flattening yield curve most likely means for stocks you're interested in. So today we'll answer the question, how does the yield curve affect stocks? So interest rates have come up more and more when I've done media interviews and on my own show on StockCharts TV. I often get questions about rates going higher or lower, what that means for particular stocks, particular groups. And I always have to caution people that, remember, when you're looking at different variables like this, especially macro variables, things don't happen in a vacuum, right? So you can come up with general tendencies. When rates go up, this is what it tends to mean for this sector. When rates go down or when the yield curve steepens or whatever, this is what it tends to mean for this particular stock. And I often phrase it in terms of headwinds and tailwinds, which is aviation terms, basically describing that there are no absolutes. It's not things are going to go up or down because of something else. They're more headwinds and tailwinds. Depending on what's happening with the yield curve, with interest rates, that provides a headwind or a tailwind for a particular sector based on the traditional relationship, their business models, and so forth. But you have to remember things happen not in a vacuum. The markets are a complex system, so lots of things are happening at any given point. Lots of variables are fluctuating. Before we get to the charts and talk about this in a little more detail, I just want to remind you, if you appreciate this channel, particularly what we're talking about, charts, technical analysis, behavioral finance, how macro inputs relate to the stocks and equities that you're and sectors that you're trading, I hope you'll subscribe to my channel. I would certainly love to have you along this ride. Also, give the video a thumbs up if you appreciate it. We'd very much appreciate it from you. Finally, put a comment below. Tell me what you think about interest rates. Do you see rates going up or going down from where we're at here in mid-June, and why? Let's get to the charts. All right, so here we're actually starting with the chart of the TLT, which is basically bond prices. This is an ETF that's looking at the long end of the curve, the 20-plus year maturities, and basically it's a very liquid ETF that I often usually refer to either the TLT or the AGG as sort of my main bond price proxy. And what we're going to do is look at the chart of bond prices. We're going to look at the chart of the 10-year yield, and you'll see the inverse relationship there. Then we'll look at the yield curve and talk about what the changing shape of the yield curve most likely means for particular sectors. So starting with bond prices, when you look at the TLT, you can see this blue horizontal line that I've put around the 140 level. Here's what's been happening. Bond prices have been in a downtrend really for the second half of 2020, arguably since the first quarter, right? Bond prices actually spiked up, really chopped around. There's a lot of dislocation in March. This is as the equity markets were bottoming out. You can see bonds, quickly came up and then really hit a secondary peak there in early August. And from there, it was a steep decline to get back down to the lows from late 2019. And that's where the TLT reached in March. You can see the shaded area that I've put on the chart here in purple. And that's where I indicated that when we were getting down to those previous lows, that was certainly an indication to me that we're most likely bottoming out in bond prices and most likely see a decline in rates. And since then, we certainly have seen that. So the TLT actually bounced up to the 140 level, got above its 50-day moving average, sort of chopped around this and tested this a number of times. Then just in the last week, has finally broken above the 140 level. So that rotation from a downtrend of lower lows and lower highs to now an uptrend of higher lows, which we put here in May, and now higher highs breaking above 140, completes that transition from bearish phase to bullish phase. The RSI at the bottom, by the way, is a great illustration of that transition as well. If you look for much of 2020 into the first half of 2021 so far, the RSI has been in a bearish range. And that means when bonds sell off, the RSI becomes oversold. When it rallies, when it goes back higher, it rarely gets above the 60 level. And that whole idea where in a bearish trend, the entire range of the RSI goes down as a classic technical approach to sort of understand the overall bias. Are we in a bullish or a bearish configuration? And I describe this usually as being in a bearish configuration. That's now changed this week, where the RSI has now finally, on a rally, gotten above the 60 level, which indicates an exit from the bearish trend and more into a bullish trend. So until proven otherwise, I think the path of least resistance on bond prices is most likely higher. Now, chart number 2 is the TNX. This is the 10-year yield. So this is now, if you think about the bond price chart, the TLT, sort of flip it over, it's kind of what you're seeing here. Rates were going higher, right? Interest rates are going up. And you can see that in the first quarter of 2021 really accelerated to the upside. This is where we had a bearish divergence, which we actually highlighted on this channel back here in March, because you had higher highs in interest rates and lower peaks in the RSI. That bearish divergence usually indicates trend exhaustion. And that's what we indicated here. From there, you can see rates have fluctuated from around 150 on the lower end and 175 on the upper end. And the TNX index that we're using is essentially the yield on the 10-year times 10. That's how they quote it. It comes from the CBOE in Chicago. And so 117.5 basically means 1.75% yield on the 10-year bond. So now we can see that, we're in this range. And now just this week, we're breaking down through the lower end of the range, breaking below 150 for the first time since back here in late February, early March of this year. So again, just like the TLT was in a downtrend and rotated higher, I think the TNX has been in an uptrend consolidation phase and now rotating lower. You can see the RSI has broken below 40. So it's now entering back into a bearish frame of reference as well. And overall, I think the path of least resistance on interest rates are down. So what does that actually mean? Well, before we get to that, I want to talk about a little bit about the shape of the yield curve. And I'll be honest, if you were looking for an exhaustive discussion about the Fed and economics and implications of monetary policy and fiscal policy, I am not the guy for that. That is not where I focus my time. I focus on charts. I focus on trends. I focus on momentum. And what I've learned from lots of conversations with strategists and economists over time is there are a lot of reasons why these relationships tend to play out. I'm much more interested in the predictability and the consistency of those relationships, and what a steepening or flattening yield curve, or what higher or lower rates or higher or lower bond prices tend to mean for stocks and sectors and groups that I would own. And that's where we're going to focus for the rest of this video. I did want to talk briefly, though, about the shape of the yield curve, if you're not familiar with that. So this might be a bit of a primer if you're not, but here on StockCharts, there's a dynamic yield curve function, which you can find if you go to charts and tools there in the upper left. And this basically shows the shape of the yield curve. And the yield curve basically starts at the short end, 1 month, 3 month. Here we're actually starting with the 3-month point and tracking it all the way to the long bond, the 30-year Treasury bond. So this basically shows you at any given moment the interest rate on each one of these points, the current active bond or the active note in each one of these points on the curve, and it shows you basically a yield curve. And you can see this is the classic shape of the yield curve, where the short term, the short end is lower, the long end is higher, and that is essentially how banks make money. Is they're able to lend at one rate and they're able to borrow at a different rate. They're able to borrow down here and lend to you when you're buying a house or buying a car further down the yield curve, and that spread from the short end to the long end is how banks tend to make money. So a steeper yield curve, as you can probably assume, tends to be better for banks, because that is really their model, is where they're borrowing and where they're lending money, and based on that yield differential between the two. Now, this dynamic yield curve is starting with the current thing. So we can see as the S&P is breaking to new highs, you see this current shape of the yield curve. But what happens if we rewind back here to like 2007, you can see a very different shape of the yield curve. This is what's called an inverted yield curve, where the short end is actually higher than the long end. Does that seem to be an environment where banks would be more likely to make money? Probably not, because that kind of flips that whole model upside down. All of a sudden, it costs them money to lend. It costs them to lend to you. This is not a great environment. The steeper the yield curve, the better it tends to be for a financial institution in general, right? So you can see as you go on, you can see how the yield curve tends to steepen and flatten. You'll notice at market peaks, you tend to have an inverted yield curve, right? And that's because of that that change in the dynamic and the rise in the short end of the yield curve. This is what the Fed is doing, is down here on the low, sort of the far left end off the side is what the Fed is doing. When we talk about the Fed decisions and the Fed rates, all the other bonds are set really more by the market. So you can see here, we got to 2019 and the yield curve was not totally inverted, but depends on how you measured it. You saw a bit of an inverted like yield curve, right? Sort of here in 2019, you see these times when, depending on how you measure it, I look at the 2 and 10-year spread, which is right here. It was really, really close, kind of right even, but in the end, it sort of, it came back and steepened back up again. And so that is one of the things that indicated going into 2020, we're entering into a recessionary period because the inverted yield curve tends to be right before a recessionary period. We've certainly seen that, but the market has moved on to the upside, and the yield curve has gone and steepened right back up. And that's what we talk about. Steepening and flattening is basically the shape of these of the yields on those different maturities. Hope that was okay. If you're not familiar with bonds, that may be a bit of a shock to the system, but I hope that was an interesting way to think about it. So let's get to the current market right now. So we can look at the chart of bond prices using the TLT or the AG. We could look at interest rates using something like the 10-year yield, $TNX. Here we're actually looking at the shape of the yield curve. So instead of doing that graphic, we're actually seeing the yield curve steepening and flattening. Here we're actually looking at 2 points on the curve, the 10-year point and the 2-year point. And I'm basically saying what's the 10-year yield minus the 2-year yield. And I can look at that differential and chart that over time. And that's what I'm seeing here by doing $UST 10Y minus $UST 2Y. I'm looking at the difference between the 10-year yield and the 2-year yield. So if this line is going up, that tells you the yield curve is steepening. When the line is going down, that tells you the yield curve is flattening, right? So what's happening now? Well, as you can see, the yield curve has been steepening from really mid-2020 on, although it really started to increase back here in 2019 with some fits and starts. But if you look at mid-2020 to really the end of the first quarter of 2021, the yield curve continued to go higher and higher. Down here, one level below, I'm looking at the relative performance, the ratio of the financial sector XLF versus the S&P, the SPY. Look at how the shape of the yield curve, when you see the yield curve steepening, look at what happens to the relative performance of financials. Financial stocks tend to outperform when the yield curve is steepening because the reasons we mentioned on the dynamic yield curve portion, right? Steeper yield curve is better for their business model. That's how they're making money. So it does well. So overall, you can see over the last 6 months, financial stocks have done very well. And if you look at the chart of Goldman Sachs or JP Morgan or a lot of asset managers, you'll see that the performance has obviously been pretty stellar. Below there, we can see the relative performance of the Qs as sort of a proxy for growth stocks, right? And if you look at these two relative performance lines, you can see that they're basically the inverse of one another, right? So when financials are underperforming, the Qs tend to be outperforming. When the Qs are underperforming, you can see financials tend to be outperforming. And for example, the first quarter of this year is a perfect example. That's when the growth trade really started to not work. You can see financials and other cyclicals starting to do very, very well. And you can see that differentiation of financials outperforming, the Qs underperforming. Here's the challenge, though, and this gets to I think the closing argument is now we're all of a sudden seeing a change. We're going from a steepening yield curve to arguably a flattening to more of a flattening yield curve, right? The 2s versus 10s has been increasing, and all of a sudden it's stable. And now in the last week, we're breaking down. So this ratio is now breaking below its recent swing low for the first time really here since last summer. We really haven't had a flattening yield curve to any significant degree in quite a while before the left side of this chart. So overall, this is a very different environment. So the environment with which financials have been able to outperform has all of a sudden changed. That was driven on higher rates, that was driven on lower bond prices, and that was driven by the yield curve steepening. And all of a sudden, you have the opposite. You have bond prices going up, you have interest rates going down, you have the yield curve flattening, and all of a sudden that would most likely imply an underperformance to the financial sector. What that should or could most likely also mean would be a rotation higher in the Qs, the NASDAQ, the growth stocks, right? Things like technology and others. And the general reason is when interest rates are lower, it's cheaper to borrow. It's easier for you to spend money. Money is cheaper for you to have access to. And so as a result, consumers tend to spend more on growthy things like new computers and cars and all sort of stuff, right? Because it's easier to do it. When interest rates are going up, it's a less friendly environment for borrowers. You're less likely to, you're not going to get a better rate for taking on any sort of debt, and so people are less likely to make big discretionary purchases like that. That is the overall relationship between the yield curve, between interest rates, between bond prices, and between stock prices. The real question here, though, is what happens next. So I would say, again, I always think of it in terms of headwinds and tailwinds. Just because yields are going down at this point, just because the yield curve starts to flatten, does not guarantee that banks are going to go down. It does not guarantee that growth stocks are going to work. I tend to think of it in terms of headwinds and tailwinds. As always, look at the charts of stocks that you own or that stocks that you're looking at. Look at the chart of the XLF of Goldman Sachs, of JP Morgan. Look at the chart of the Qs, the NASDAQ 100, Microsoft, and Facebook and others, and make your own assessment about what those patterns are telling you. In general, I would encourage you to follow the momentum, but lower rates tend to mean worse for financials, better for growth. So that's it. That's a quick primer on the yield curve, what it means, how it's set up, what higher rates, lower rates, steeper yield curve, flattening yield curve means for two key sectors, financials, or two areas in the market, the financial sector in particular, and growth stocks. We talked about how this yield curve starting to flatten and rates coming down would most likely be a tailwind or a positive indication for growth stocks like technology, more of a negative indication or sign of underperformance for the financial sector. It doesn't necessarily have an implication, I would argue, for the broad market. I think those charts that I showed at the bottom of that previous slide are all relative charts. Right? It's looking at one sector relative to the market. The S&P itself is its own beast, has a lot of other variables at work, not just the bond market. So pay attention, and when in doubt, follow the momentum. That's it for this video. I hope you enjoyed it. If you appreciate these videos and what we're doing with market misbehavior, I hope you'll subscribe. It'd be awesome to have you along this journey. Also, give us a thumbs up if you could. We'd appreciate a like very, very much. Finally, put a comment below the video with those sectors, with the financial sector, with growth stocks. What do you see going forward given the potential weakness in rates? From everyone here at Market Misbehavior, I'm Dave Keller. Be well, be safe. Talk to you again soon.